we could easily add another $1,000 in the course of the next 18 months, I think, which would push us almost to 5,000. And I'm not excluding the possibility it might go a lot faster than that. There's a whole bunch of things which might happen between now and then, which might push the gold price up to, well, I'm going to say but could go much higher. We might even see, and I don't think it's a likely probability in the next 18 months, but it's a possibility, we might even see some sort of currency crisis where there's a panic about a particular currency, and it doesn't matter which one it is, whether it's the yen, the pound, or the dollar. If we get a currency crisis and people start to say, oh my God, this currency, I don't want it, and that everyone's rushing down to the shops, it can spiral across borders very quickly.
Gold keeps climbing, and according to retired Swiss banker Clive Thompson, this run still has a long way to go. He says prices never move in straight lines. There are always dips and corrections, but the broader trend remains intact. Whether gold takes a breather for a week or even a month, the long-term direction still points higher. Thompson believes gold's strength lies in its reliability. In a market driven by hype and speculation, where tech stocks like Nvidia can soar or crash overnight, gold stands out as the opposite: calm, steady, and proven. It doesn't promise quick profits, but it preserves purchasing power through cycles of inflation, debt crises, and monetary uncertainty. That's why more investors, from individuals to central banks, are quietly moving back toward it. He points out that while central banks remain consistent buyers, though at a slower pace than last year, retail participation is picking up again. Gold ETFs are seeing renewed inflows, suggesting that small investors are starting to hedge against what they see as rising financial risk. If the current momentum holds, Thompson sees gold climbing another $1,000 over the next 18 months, possibly touching $5,000 an ounce. But if a major currency shock hits, like a collapse in the yen or euro, he warns the move could be much faster. In that kind of panic, fear itself would drive demand, and gold could surge far beyond anyone's expectations. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
So what I see happening to the price of gold, long term, I think it's destined to go much higher. These things never go in straight lines, but we seem to have gone in a straight line for a long time. So it would not surprise me if we have a bad day, week, month, but not a year, I don't think. We're in a very unusual situation, one which we have never seen before, and that is one where dollar holders don't know what to expect tomorrow. If we go back a few years ago, you could be fairly sure that if you had a dollar receipt coming in, you knew roughly where it would be 6 months from now or a year from now. You trusted it. Now people are saying, I can't tell what's going to happen tomorrow. There's, tariffs and surprises and political agendas going on, and it's all over. So although the dollar isn't really moving, there's this general feeling of uncertainty, and people are saying, you know what, they've weaponized the dollar. There's this going on. There's that going on. I'm not sure I can keep everything in dollars anymore. And so part of it's moving into this safe haven. I mean, they're looking around for safe havens, and you can't call Nvidia a safe haven anymore. I think some of the money which is looking for that lower volatility, that greater degree of safety, is heading into gold, because people are saying, well, I don't know about the dollar, but I'm pretty damn sure my gold will still be there next year. I'm pretty sure it will buy something. And I think there's that certainty which is driving gold higher. On top of that, we've got the central banks. They're not buying as much as they were a year ago, but they're still steady buyers of gold. And to a smaller extent, we've got the public starting to come in and buy into the gold ETFs, where the number of tons in the ETFs have been starting to rise. It's not spectacular, I would say, but there's been a sort of little bit of a trend change from the public, the man in the street, who's starting to say, maybe I should have a little bit of gold just because I can't have it all in Nvidia. There's an awful lot of people who wish they bought at last week's price or last month's price. So what we've seen recently is every time there's a short-term pullback of a day or two in the gold price or the gold mining stocks, almost the next day, there's surges of buyers coming in and pushing it back to the previous price and higher. So there's a lot of people waiting for that dip, and that means that when there are these dips, not going to go far because everyone's trying to second guess when they go in, and they want to be before everybody else. And the minute it starts going back up again, they think, quick, I better get in before it moves. And then there's this race as people leapfrog each other, putting their bids in to try and buy the share price. The other thing, for people who don't know what they're doing really, there's the gold mining exchange traded funds. Now, an exchange traded fund is a fund which holds hundreds of, or so tens of investments, maybe 40 or 50 investments in a particular sector. So the one which most people can look at is known as the Van Eck Gold Miners Index. Its symbol is GDX, letter G for golf, D for delta, and X for X-ray. So GDX basically will trade at the net asset value of those underlying 40 or 50 shares which are held by it. It's a very, very large fund. It's in the billions. So when you buy the GDX, you're getting exposure to a basket of 40 or 50 stocks, which will move in line with the average of the gold mining stocks, up and down. So that's a very interesting one to get into, because you don't have to think about this one. Is this gold mining company better than that one? But of course, there is an effect when people put money into the GDX. The GDX has to buy everything in the underlying index. So the good and the bad all get pushed up on a rising tide by the purchasers of ETFs like the GDX. But I think that's a very safe way to get in, because you're not exposed to the specific risks of a single company. We mustn't forget that gold mining is a very risky business for most gold miners. They have the risks of cave-ins, landslides, mud flows. There's obviously in many countries industrial action. There's electricity shortages in South Africa, maybe, for example. There's political risks in lots of countries, because most of these gold and silver miners they're not in nice, safe Australia or Canada or North America. They're in places like Africa or Peru or Mexico, where the politics are not at all the same, and you never know. So if you're into an exchange traded fund, you own a bit of everything, and you've got gold mines all around the world, and some of them will go bad because of politics or because of some disaster somewhere, but collectively they should do very well. Well, it's been going up much faster than I expected. And I think that continues at a similar pace. So we could easily add another $1,000 in the course of the next 18 months, I think, which would push us almost to 5,000. And I'm not excluding the possibility it might go a lot faster than that. There's a whole bunch of things which might happen between now and then, which might push the gold price up to, well, I'm going to say could go much higher. We might even see, and I don't think it's a likely probability in the next 18 months, but it's a possibility, we might even see some sort of currency crisis where there's a panic about a particular currency, and it doesn't matter which one it is, whether it's the yen, the pound, or the dollar. If we get a currency crisis and people start to say, oh my God, this currency, I don't want it, and that everyone's rushing down to the shops, it can spiral across borders very, very quickly. So let's say the Japanese yen were to fail, as an example, everyone in every other country is going to say, what if we're next? And what do you do? What do you do if you fear you're going to be next? You take the money you've got and try and get something else. But suddenly you find nobody wants to take your money.
Silver's setup looks stronger than it has in years, says retired Swiss banker Clive Thompson. He believes the metal is on track to break its all-time high soon, and the data backs him up. According to the Silver Institute, global mine supply has lagged behind industrial demand for several consecutive years. That persistent deficit is the foundation of this rally. When new production can't keep up, the market depends on recycled silver to make up the shortfall. But recycling only increases when prices rise enough to motivate holders to sell old coins, jewelry, or bullion, which in turn pushes prices even higher. Thompson points to China as another major factor. In its push to revive economic growth, Beijing is investing heavily in renewable energy, especially solar power. Solar panels require significant amounts of silver, and demand from that sector has surged roughly 30% in recent years. Even if that pace cools slightly, solar remains one of the strongest and most consistent sources of silver consumption worldwide. He adds that rising prices will likely trigger waves of selling from investors and households sitting on long-held silver. But even with some of that supply returning to the market, Thompson says the overall trend remains unmistakably upward. Let's get back to the interview.
We're going past the all-time high over time. I don't think that time is particularly long. We do know from looking at the Silver Institute's numbers that the mined supply of silver is considerably less than the industrial use, and that has been the case for about 3 or 4 years. And that explains why the silver price has been going higher, because the only way you can get the silver you need to meet the demand is by recycling. So to get recycled silver, you have to have a higher price so that your granny brings in her candlesticks to the pawn shop, and some investor says, I've got this bunch of bars or coins I bought 5 years ago, I've got a nice profit, and they take it along to a gold and silver shop. I don't know where it is everywhere in the world, but here in Switzerland, we've got places all over the place say, we buy gold, we buy silver. So people take their stuff down, hand it over, and get the money because they like the silver price. And the higher the price goes, the more it will get people out. So that explains why the silver prices had to go higher to suck out this silver for recycling. And I think the silver demand continues to rise for one main reason, but it's two reasons related, in fact. The first main reason is the main usage of silver is in the electronics industry. We are not going to have less electronics in the future than we have today. We've just seen very recently the US, I don't know the government, anyway, some US agency which is part of the government say that silver is now going to be a strategic mineral for the United States because they used to have a strategic stockpile of silver, which was used by the military because it's used a lot by military. That's completely gone. Now they've decided it should be a strategic mineral, which means that they should start to build a stockpile again and they specifically say what the risk is. The risk is we might not be able to get silver out of Mexico. So if they suddenly can't buy because that's where most of the silver, a lot of silver comes from. If they can't get silver from Mexico because of maybe some political problem or internal industrial action or maybe some civil war or who knows what, it would be a problem for the United States because it would damage US industry, it would damage the weapons industry. So I think that could be another factor, that this stockpile potentially might be rebuilt. And the trouble with that is there is no silver, because it's all consumed by industrial use. So they'd have to push the price. The price would be pushed higher if they go into the market and start buying. Now, if they do so, I suppose they'll do it very gently because they don't want to overpay. But that's a factor. So first of all, that's the first thing. The electronics industry in general, it's not going to go backwards. And we've got the potential stockpile. But the second thing I think we've got to say is China is trying to stimulate its economy, and the solar panel industry is likely to be getting a big push out of the Chinese government, because that's something which is easy to sell to everyone in the world. Get cheap energy and cheap energy, they call it clean energy. So I think we've got this non-stop push from China to make more and more solar panels which use and consume silver. And of course, the solar panel industry has been a big driver in the increase of use of silver. I think 2 years ago, we saw something like a 30% increase, or the amount of silver being used in solar panels went up by something like 30% in a year. It's not so much last year. I think it continues higher for the supply and demand, and I think it's also heavily influenced by gold. One of the things we do have in the demand, when I say industrial demand, part of that is not really industrial demand, it's investor demand. And the estimate from the Silver Institute is that 200 million ounces will be bought by investors this year. I think that's going to prove to be a big underestimate. Because if you think about it, 200 million ounces, and take the population of this planet, which is 9 billion people roughly, and divide and take that 200 million ounces. That means only 1 in 45 people will get 1 ounce. And I think more than 1 in 45 people are going to be making their first silver purchase this year. And I don't think all of them will be buying just 1 ounce. I think some of them will be buying 10 ounces or 100 ounces or 1,000 ounces. So the assumption that only 1 ounce will be bought by every 45 people on the planet for investment purposes seems to me to be an underestimate in the current environment when the silver price is rising and people are starting to notice it. Because people, when something is moving in price, they tend to hear about it. They've got a friend who says, "Hey, I made some money on silver," and they talk about it, and then they say, "Oh, I'll buy a silver coin. I want to be like you." We all want to be part of a clique. If you go to pick a church, your friend goes to a church, you might want to go to the same church. If your friend's a member of a club, a Keep Fit club, you join the Keep Fit club. If your friend buys some silver coins, you might buy some silver coins. It's a way of making that connection. So I think that because people will be talking about their silver purchases, I think it will bring in a lot of people to buy their first silver coins this year. And I think that 200 million is going to be a big underestimate. And to put that in context, I think it's the annual production of silver is about 800 million ounces a year. So it's maybe 900 million ounces a year. It wouldn't take much if we buy 1 ounce for every 22.5 people instead of every 45 people. That would take it would be half of the global mine supply going into investment pots.
The story unfolding now isn't about chasing price targets, but about rediscovering value that doesn't vanish with a policy shift or a central bank statement. Gold's calm endurance and silver's tightening supply are telling the same story in different tones. Stability is becoming the new form of growth. Investors aren't just buying metals. They're opting out of a system they no longer trust to protect their savings. Every ounce acquired is a small vote against paper promises and a quiet nod to history's oldest insurance policy. If silver continues tightening and gold keeps attracting cautious money, the next leg up won't be just another rally. It could mark a psychological turning point in how the world measures wealth. When confidence in financial systems begins to fray and tangible assets rise to the forefront again, will this be remembered as the moment people return to real value, or the point where paper money finally lost its credibility? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.